So thank you for coming at short notice. All of you here are either taking the trial or you're a paid member. So just wanted to brief you with how um, our system works, or how when we send out the trade messages, what do you expect? Because we receive emails and questions. So why not I explain to you? Also, whenever a new member joins, whether the trial or paid, we send out a 71-page guidebook. So, and there is another 121-page option strategy book. So you must have those books, at least the 71-page. So it explains, and I'm constantly improving those guidebooks. So when we update, because we have done some improvement, we are updating it, and when we update, we will send you the new copy. So in the meanwhile, through few slides, so it's 20-25 minutes, few slides, I will explain the different trade messages and what we do during the trading hours. And this kind of a quick 20-minute session, I will hold regularly. So even if you have attended today, the next time you receive a notification, you just simply come. And if you miss it, you can watch the recording on our YouTube channel called The Real Trade Genie. And we can also send you the recording. So let me explain how the things work in this short session. So during the market hours, so before the market opens, so let's start from the before the market opens. So before the market opens, there's some work goes on with respect to the preparation of in the market. So my routine is wake up, you know, shower, pray, coffee, a little bit of breakfast, read the news, communicate with my team, see the market. So market, futures market, what will be the cash market will be depending on the futures market and other ETFs, etc. And the open position, and if something is moving during pre-market hours. So that kind of a work goes on, some mental rehearsal, something I do. So all that preparation, and then when the market opens, so when the market opens, there are two kinds of monitoring goes on. So every trader should do two kinds of monitoring. One is called detail monitoring, and another one is the overview monitoring. So in the beginning, when the market opens, you have to do the detail monitoring. So detail monitoring means you're looking at, first of all, you need to look at all your open positions. You also need to look at the market conditions, what the market is doing and expected to do, where are the support resistance, where it can fall, where it can rise, what are the important numbers. So you do all that. So this is all going on in a detail monitoring. So in one of the screen, you're watching the market, in one of the screen, you're watching your open position, etc. There's another screen for just for news, or if you're communicating with someone, uh, if you're communicating with very little or very important stuff. The phone is off, the TV is on a silent mode or very low mode. So all that goes on. So it's called detail monitoring. So after the detail monitoring is done, then when the detail monitoring is done, so one by one, let's say I have 10 positions. So one by one, I monitor those 10 positions, and then I switch those out of those 10 positions, maybe 7 of them to overview monitoring, which means I am just looking at the daily chart. They don't need to be watched on a lower time frame. So that's one thing I do. So don't need to watch on a lower time on a day chart, because if the stock is there and doing its thing, it's doing its thing. It's unless there's something drastic happen, uh, most likely it will just do its thing on the daily chart. So don't need to watch too much. It will not make any difference if you're watching it on a 1-minute chart or a 2-minute chart. It's useless. It's distracting. So just a second. So it's distracting. Like right now, I got distracted. So so only those charts which where the exit protocol is about to trigger. So let's say that you have a target set and exit protocol trigger. So exit protocol triggers means, it doesn't mean that you just take exit. Exit protocol means something telling you to look at it. Let's say a target hits, the moment target hits, I get all my trades are set up. The targets are set up in advance. So the moment real time, as soon as the target hits, so I call it three targets, first, second, and third. I also call them green, yellow, and red. So when the target hits, I get the notification. So when the target hits, not only the target for that stock, but the option. So option needs to be also need to be uh, uh, watched. So just a second, I need to. I'm getting distracted. Just a second. Okay, so the target needs to be watched, not only the stock but the option. So let's say the target was 102 and the position was open in 99. Now the stock target hit 102. So what was the option price? So if option gain is 30%, 35, I get the alert also. This is the option gain at this target. So if the target is important, then I go back and look at the lower level chart. So I do that. So I'm going to explain how the targets are triggered, what I do, and how I communicate, how Trade Genie communicate with the members. So let's explain. So let's say that this trade called Facebook. So it's Meta. So Meta, we are looking at just for the example sake, Meta March 245 call. So let's say the Meta triggers on the daily chart. So I'm a visual trader. I look at it and I say, okay, this needs my attention. So go through the process of stocking and the other checklist rules, etc. So go through those steps, and it qualifies to trade. So when it qualifies to trade, we put the symbol Meta and then March, let's say 245 calls. So March is the month, 245 calls. We always buy the third Friday expiry. So there are various expiries. We don't buy the other expiry. Most of the time, the options are trading in a crazy manner. The spread is huge and etc. The third Friday is the most stable. So by the October or November, let's say the November or March in this example, the third Friday. So I'm buying March calls, third Friday, 245 is strike and it's call. So if it's puts, it will show puts. And then buying to open at 10. So 10 is that price somewhere if the spread is, let's say it's trading at 960 and 1010. So it's trading at 960 and 1010, so 50 cents is the spread. So I put 10 or 990. So somewhere the mid price between the bid and ask. So that's the suggested price and the third Friday expiry option. So when this trade is sent, it is sent via email and SMS. So SMS to those who have given us their phone number. So we do send out SMS to those who have given us the phone number. So if you want to receive SMS messages, just provide your phone number with the country code to support@tradegenie.com, and we will add you to our SMS. So SMS is emails are also delivered right on time along with the SMS. There is no delay, maybe few seconds, so it doesn't matter. But the importance is that text messages you read immediately, you get a ding and then you can read it, and it's one line, like just one line. It's brief, that's it, and it says details in your email. So you would receive just one line like this: FB March 245 call, buying to open at 10. Just one brief line on your phone, and you open your platform, so application on your phone, so it's very quick, and you would put the symbol FB, select the March 245 calls, third Friday, and you would see it's trading at 10. No need to chase. If it's trading at 1040, 1050, no need to chase. It will come down. It's not like it's gonna end. You will not get the trade. We don't do all those kind of tricks where buy first and send the alert. So we don't do all those things. And if the trade is moving, we are not a momentum trader, so most likely you will get fill. And I monitor the trade, the fill orders, and I monitor the ask and the bid. So I'm monitoring it. If there is some adjustment to be done, I send another alert. So let's say you get filled at 10. So I know it get filled. I get filled on my so I although I have 14 monitors and all that, but I do use the app on the phone to get filled or watch the open position, just the brief open position, and just to see how other members are doing it on the app. And they are also getting filled, different brokers, but just one broker. So I have the order ready on the phone, and I send the alert and I buy on my site. So the moment we buy, then so before I send out the buy order, there's a lot of work done already, such as where is the support, where is the resistance, what are the targets, how I expect the trade to materialize, how where it will move. So all that work is done, but I'm not telling you at the time when I'm sending the alert, because I don't want to write a story. By the time I write a story, you get busy with reading the story. I don't write the story about it. Members are concerned, just tell me which one to buy and what are the targets. Be very specific. So over the years, I've learned members need very specific information. They don't need, we call it Ram Kahani, no more stories. Just give me something to, and then you can explain later. So once the trade is sent, there is another variation. Let's say after the trade is sent and the targets are sent, etc. But the trade did not hit the target. So it pulls back to some price where we know it's bouncing back up. So at that time, we can send you another alert to buy more if you can. So initially, you always initiate your position with the half of your lot size. So if you have $2,000, if you plan $2,000 into it, then you put $1,000. So you bought one contract. Now when we are sending you the alert to buy more, so for another 1,200, you can buy two contracts for $6 each. So equal dollars, not equal contract. So you buy two more, so your average price will go down. If not, your original price will be 10. So we do this sometime when the trade has pulled back and it's now bouncing up. So another way of, so we do provide you the target. So the target we provide is the stock target, not the option target. Like we don't say, okay, you bought a 10 set at $15 for 15%. So we don't do this kind of, because we don't know how, what would be the, how long it will take and what will be the option price, because the option have a complicated formula. So we don't know how it will, what it will be. But, and we are not trading, we are using option to trade stocks. So we are trading stocks, reading the chart of the stocks, not reading the chart of options. So I don't know how people can read the chart of options, but I don't. I read the chart of the stock. So the stock, you can, on the layout, you can see previous journey, where are the turning point, and you can set the targets. So whatever is the option at that point, that's what we sell. Sometimes it's at a loss, sometimes break even, sometimes it's gain. So a different situation, whatever it is. So there is a feature called conditional order. So you can set the conditional order. So there is a conditional order feature on your brokerage platform. So conditional order says that sell my option at market price when this target hits. So whatever condition. So condition can be any. When the market hit this level, sell my all my contract, or sell 3 contracts at this stock target. Sell another 3 at this stock target. Sell another 2 at this stock target. So this is a conditional order you can set for your calls and puts. So make sure you do some practice on your simulation account with one contract and see if you're setting it correctly, because there is a greater than or equal to conditions. So ask your broker that I want to set the conditional order, so they will guide you. So conditional order is that when that condition triggers, you are selling your contract at the market price. So whatever is the market price. Don't set the conditional order for those options where you see the very low liquidity and the spread is huge, because then you will be out at not the price you will like. So this conditional order works when there's a liquidity, spread is tight, and there's a lot of activity going on. So then you get proper fill. But if there's no activity, first of all, we avoid those stocks where there's no activity in the option or very low. So when the stock hits, then your option order becomes the market order. And the market order will trigger at the last price. If the last price is way below your expectation, you will get filled. Market maker will take your order, and you will be not happy. So just set the condition order for those stocks which are liquid. Options are selling at a very tight spread. So if there is any update after we send the buy, so we send out the targets. So I'll explain the target in detail. If there is any message related to that trade, news update, technical update, volume update, we send the update. We revise the targets. We send you the revised targets, and we send you all the sell orders emails. So, and sometimes we send you the alert to get ready to take profit when the market is moving, when the position is moving, and we know that we need to hold a little bit. So if the target is hit, but it's moving beyond the target, so we do that. You get the immediate notification via email and SMS. So all this communication is going on with the members. Now, the most important thing is the target. So there should be a multiple exits. The traders who are successful, they have multiple exits and complicated exits. Your entry should be simple, no more than 10 criteria to enter, check rules, but your exit should be complex. So exits can be, you can have a complicated, if you want, you can have a complicated worksheet, and then you can implement it based on your rules. So you can define the rules on your worksheet, and then if you have a programming ability or skills, or you know someone, then you can program your exit, or don't need to program as long as you can follow your rules of exit. So the exit needs to be complex, and exits are for the top traders. Their exits have multiple exits, and they are complex. The entries are simple. So entries are simple, the exits are complex, and exits are multiple, entries just one, and maybe they have a strategy for scaling in, and they have a strategy for re-entry. So when they exit, got out because of the loss, break even, or some profit, and then the trade is giving another entry. So they have a system for re-entry, or they have a system for scaling in. So scaling in is a very good strategy. You should have a scaling in strategy to maximize your gains, because there is a one trade in a week which is a winner, big winner. So that is the trade where you need to scale in and have a proper exit. So when you're scaling in, your risk is remaining the same, or it's increasing a little bit. So you're not doubling the risk. So scale in and then scale out. So scale out is another strategy of scaling out. So for scaling out, you need to have a multiple exits. So that's why we provide you 3 targets. So target is the targets is the most important um, factor in your trading, the exit. So the exit could be time-based exits, exit could be based on the market condition, exit could be psychological, exit could be anything, any other combination, the percentage or the profit targets you have, or exit could be based on support and resistance, exit could be based on the turning points, exit could be based on the combination of all that, the days to expiry, days in the trade, how much profit you have, how much you have already sold. So you see, it can be complex. So you need to focus your positive energy onto a desired result and stock target. So if your exit is based on the target on the chart, so that's the ultimate. You are exiting based on the target, or you know when the target is hitting, what else you will do. So it's a science and art. The stock must follow the target like a precision guided missile. So precision guided missile, the stock should follow, and your skills play a role in setting up the targets. So I'll explain to you the targets. So we have 3 targets, and we call it green, yellow, and red. Green, yellow, and red. And the green target is the first target, yellow target is the second target, and red target is the third target. So that just like the traffic light. And there is a reason I call it green, yellow, and red. And then there is a beyond red target. So green, yellow, and red beyond. So I'll explain to you quickly about the targets. So now the green target is the immediate target. So let's say we enter at 100, the immediate target could be 103. So the smaller the target, the distance, the more accurate you are supposed to be. The distance is far, the less accurate you are. So if you are traveling from San Diego to Seattle, the GPS will, by the time you reach Seattle, I'm sure if you put in the GPS from San Diego to Seattle, it will say maybe 24 hours. But by the time you reach Seattle, you reach there in 72 hours. So what happened? Because you stopped here, there, took a nap, sleep, lunch, dinner, took a wrong exit, get back. So it took, instead of 24 hours, it took 72 hours. Whereas if you're going from in San Diego from one place to another one, which is 5 miles away, the GPS says you will be there in 7 minutes. Most likely you will be there in 7 minutes, maybe 7 minutes and 30 seconds. So that's the you understand the target. So the green target is the immediate target, which has a 95% probability of a stock hitting this target. So because it's closer and the stock is there, we can see. So there is a probability of hitting the target. Now, not only the target is hitting, but it's giving us some gain. So the target is chosen that at least you have 25 to 30% gain in the option. So when I get the alert, so when I'm setting the green target, I see it's not like, okay, the stock entry is 100 and I send the alert for green target at 101, and then I say, okay, green target hit. So green target may hit, but there is no gain in the option unless you have share. So you will make 1 point, but in the option you will say, no, only 30 cents gain. So we know that. So I don't set the green target and set the target such that you have 25 to 30% gain in the option. So when the target is hitting, I'm also looking at the option gain. I get the alert that this is the option gain. If the option gain is not enough, let's say 10%, or even if it's at a loss, the green target is hitting, but the option is losing 10% instead of making 25. And why? Because it took time for the stock to hit the green target. It just stopped there and it did not move. So when it stopped there, it did not move. The green target is hitting, but there is no gain. So when that is happening, we revise the target. The green target, we move it up. So yellow target, which is the second target, becomes the green target. So we monitor and we do that. So when the green target is hitting, we send you the alert, sell at least 1/4 of your position or 1/3 of your position. Sometimes sell half of your position. So we send you. Ideally, you should sell as little as possible on the green target because it is a small gain, 25, 30. You need to hold to yellow target, which is the ultimate target, the yellow target or the red target. So it all depends on how many contracts you bought, how much exposure you have in that position, how long it took for the green target. Sometimes the green target is the target which hits, and the targets are not written in a stone. You need to be flexible, not rigid. Sometimes there is no target left. What we thought the target, because the stock got stuck in the consolidation mode, so now we are happy to sell all at green target. So there is a flexibility you need to have. So we send out the alerts depending on what the stock is doing and the target and the number of days it took for the stock to hit. So if we get buy now and tomorrow the green target is hitting, we may get 40% gain because there is no time delay. There's only 1 day delay and the option suddenly moved and we got 40% gain. Whereas another position where we can hold for 8 days and the green target is hitting now, there's only 10% gain. So what we do, we revise the green by yellow target, and the red target is new target, and the yellow, the red becomes yellow. So we upgrade the target. So there's a yellow target, which is the second target. So the second target is after the green target, and 85% probability of stock hitting this target, and the stock expected to pull back after hitting yellow. So the yellow target is set near some resistance level. So the resistance levels, there are different kinds of resistance. So some are very Some are tough to break, some are mild, and some are very, they are just resistance because there's only one time the stock hits and pull back. So that is not a resistance, but at least there is a, we can call it resistance because it hit one time and it pulled back. But if a stock has hit 3 or 4 times, then it has some resistance. So that is the target I'm looking at and calling it yellow. So just like traffic signal that you see, even the kid knows that the yellow means slow down or stop. So slow down. So on the yellow target, I expect our option to gain 40 to 50%. So yellow target, we expect option to gain 40 to 50%, and there is the 85% probability of stock hitting the target. So when the yellow target is hitting, we send out the alert to sell half or majority, something like that, sell half or majority or 3/4 of your position, because we expect, because it's a resistance, no matter how, unless the cannonball is fired at the yellow target, unless the cannonball with a huge volume and the stock is just penetrated quickly and is moving away from the yellow target, so it will go quickly towards the red. Most likely it will stall. Some kind of a stall will happen at yellow target. So when that happens, I don't want to be holding that position, because for a stock is okay to hold because there is no time decay, only the opportunity cost. So there is opportunity cost, and we need to be aware of there is. Um, uh, if you keep holding a position and there's no buying power left, and the stock is trading at some resistance, you may be missing out some other opportunities. But so there is a analysis you need to do. There's a skill that switching your position from one to another is profitable or not. Sometimes it's not. You just keep holding your winner, even though it's hitting some resistance, and it will travel towards the next target. Because when you opening a new position, that's where you're making the biggest mistake possible there. Because you're deciding at that moment whether to take the trade or not to take the trade, and there are conditions triggering which will telling you to take the trade, and you may get distracted, and that's where the loss comes. So the moment when you push the button to buy, that is the most important uh, moment, and when we are exiting. In between is the management. So make sure that when you're exiting at yellow, you know what you're doing, and you can see the red target is far. So do the calculation and see, okay, I sell this much and hold this much for red. Sometimes the red and yellow are closer. So if that is the situation, then you just sell it between yellow and red or at yellow. So we do send out the sell majority alert. Now, when we send out the sell majority alert, so the red target should hit within 3 days or 2 days. If the yellow target is hit and we sold the majority, then the red should hit in 2-3 days. So we have set up the condition where if we have sold the majority and 2 days gone by, 3 days gone by, and the red target has not hit, we monitor and we send out the alert to sell the rest of your position. So we do that, and you should see sell rest. So sell rest. So if you had 10 contracts, you sold 8, 2 left, sell rest. And if the stock hesitates to move up, sell rest. So if you can also decide on your own. So remember, nobody can make you money, but only you can make money yourself. Others are just helping you, guiding you. So you are the most important factor in your trading, and you are the most responsible person for your own account. Nobody will is responsible to make you money. It's just others are just helping you. So only you know your situation when the yellow target is hitting, what else you're doing. Maybe what happened is when the yellow target is hitting, we are sending out a brand new trade because we know the yellow target is hit, selling the majority. This is a new trade. Members can get in the new trade. So you can see that coming in. Or when the new trade is sent, 30 seconds later, alert is sent to close some trade which is at yellow target. And most of the targets are hitting in early morning, so the first hour. Because if you open a position and the next day market gaps up and it's hitting the target, so we send out the alert. So that is yellow target. The third target is called red target. So we call it red target, which is the third target, which is after yellow. So remember the Seattle example from San Diego to Seattle. So now the red target is like Seattle. So it may take time. It may go fast, like you travel quickly and the GPS said 24 hours. You were in Seattle in 24 hours. And the reason the red target gets hit because of the momentum and some news comes and boom, 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 it just goes and hit. So when the red target, which is par, and it hit quickly, you can make 80 to 100% gain because of the option move fast. So there is a 70% probability of a stock hitting this target. So just like there's a 70% probability when you travel from San Diego to Seattle that you will reach in 24 hours uh, if you keep going. So now the red target, uh, the way the red target works is based on the resistance level. So if I am reading the resistance, other traders are reading the resistance. It's not like, okay, I'm the only one reading the resistance correctly and others are not reading it. So if others are reading it also, they have their cell program also. So they are very smart. So they have many conditions. So they exiting before even the red target is hitting. You think, okay, this is the resistance. So you are, first of all, if it's a resistance is 100, you are not setting your sell order at 100 or 99.90, 99 point. You have to have somewhere like 99.10, 99.20. You need to jump the ship before the ship reaches the dock, or jump the train before the train reaches the platform. You have to really jump. So, and it looks really good when the target is hitting. There is a momentum. There is something magical happening when a major target is hitting. The stock looks really good. The volume is up. The market is looking good, and the target is hitting. And we have a tendency to become greedy and cancel our sell order. So we have a tendency to cancel our sell order because it's looking good, and that's where it's like a break. Boom! It's just hit, and by the time you know it, the stock already pulled back significantly. So your sell order should be placed in advance. So there is a 95% probability of a stock missing by few cents. So very high. So I've seen it. It just, you miss it. 95% probably stock pulling back significantly. So the red target is such that it can pull back. The stock can pull back and go to yellow target. So again, the psychologically, we saw something green, big green, and now we don't see that much green. Although we are in a profit, psychologically it causes damage, and then we tend to hold that position. So we don't want to hold the position. And if you don't want to go into that mode, which is demoralizing, you set your sell order in advance. Calculate the option price and be happy that you are out. So when the red target is hitting, we are also sending you the sell rest. So sell rest is triggering when the red target is hitting. Sell rest is triggering when we already have a sell majority going on and 3 days pass. Sell rest hits when, let's say, we sold half of the position and 1 week gone by and the stock is just sitting at where it was. So there's no point. We sold half and the stock doesn't move, 5 days gone by, we need to sell the rest. So there are various conditions of sell rest, and we do send the trade alerts. So red target is the third target, which is the important one. Now there is a revised red target. So sometimes the stock just keeps going, so we revise the target. So we put a new red target. We tell you in advance, we give you the new red target. So the red target becomes the yellow target becomes the green target, and then we send you the revised red target. So when we send you the revised red target, and the reason is that we want you to maximize the gain. If there is a potential there, why we don't close the trade. So we want you to hold it, keep holding the red target beyond the red. So we call it revised red target. Sometimes in the pre-market or after market, the stock has already hit the red target. It gapped up, and we see that when the market gaps up in the morning, it gapped up above the red target. So when the stock is uh, opening up beyond the red target, whether up or down, then so we evaluate at that time whether it will hold or it will pull back, or how much it will go, because maybe there is a new catalyst. So when there is a new catalyst and the red target is hit and is trading beyond, then it's like a new leg. for that trade. So you can ask yourself, if you were trading, if you looked at that trade and you were not in the trade and you look at that symbol and you see the stock gapping, would you buy in this trade or scale in? So at least the answer should come, yeah, I would scale in this, or something's telling you that it's looking good. So on a scale of 1 to 10, you would rate that trade 9 or 10 at that time. So if you were rating it hitting beyond red, and on a scale of 1 to 10, you are rating it at 9 or 10. So if the answer comes 9 or 10, then you should hold it and go for a bigger gain for the remaining contract. Or maybe you did not sell any and now you have a jackpot. So red target is revised to capture more gains. So what to do to maximize gains? I'm just giving you some example, and I will hold some more webinars to teach you how to maximize the gain from our trade messages. The stock gaps above red target, stays above red, safe to hold, breaks below red, sell immediately. If it goes above red and then comes down and pull back below red, then it means that you need to sell, because that's it, the game is over. The stock has reached its temporary top. So temporarily it is just hitting it. And if you're a technical analyst, you should be able to see on the chart that the stock has reached its peak for now. For 1 week or 2 weeks, I'm out of here, because there is a cost opportunity. You can, if you have the ability to switch your position from the one right position to another right position, from another right position to another one, if you can switch that and you can exit without any remorse, take profit or take loss, you are way ahead of the game from others. So you have edge over others. So do that, see what it's doing at red target. So we do send out the target revised, target adjusted upward. First target price is replaced by second target price. Second target price is replaced by the third target price, and new third target price is given, and target may get adjusted to downside too. So sometimes we do adjust the target to the downside. So you will say, okay, the red target was 106 and now it's 105. So there is a reason for that, because now we see that there is a resistance at 105 and we cannot expect our stock to go above 105. So we do adjust the target to the downside, which means less profit, but it's safer to exit. So understanding multiple exits, we send out selling 1/3, selling half, selling majority, selling rest, selling all, sell price range. Sometimes we give you the range of the stock. The sell your options between 101.50 and 102, so 50 cents. So you have, then you decide 101.50 to 102, you need to sell your option. Or we send out the message sell to close by market. So we do that. Or we can send you the alert when the major index is hitting, some major index hitting some resistance, and we expect the market to pull back. So we send out the alert. So you see, the exits are complicated, and it can be very complicated. This is just a brief scenario. So when you have 2 or 3 variables in your decision, the end result could be in millions of scenarios. It could turn into millions of scenarios. So we don't want the millions of scenarios. We want few and nice scenarios, but there are various combinations of exits. So the top traders, they have multiple exits, complex exits. They know when to exit, when to maximize the gain. The entry is simple. Entry, you can just throw the dart, let's say 500 stock, and you say, okay, this one is green, I just get in, and then you get in. Now where to get out, you don't know. So also we watch pre-market and aftermarket, because a lot of stocks, they can hit the target in the pre-market, and we need to be aware of. So red target hitting in a non-regular session. So if it's a red target, it's a major resistance, and there is a trading activity going on during pre-market and aftermarket, then the stock has done its thing. Now when it opens, it will open below that price, which it made, the high made on pre-market, and it's just trading below that price, and you're waiting for that stock to go back up, and then you wonder why it's not going up. It was doing good because it hit some major resistance in the pre-market. So need to know that some event is occurring. Chances are stock will pull back when the market opens. It just gap up and then pulls back. Stock for red target, to hold the red target, it must cross with a bang or gap up, something major thing happening at the red target. and must continue upward. And so when we see something happening in a pre-market, we send you the alert in pre-market. So in order to maximize gains, you need to have a plan for scaling in at the major pullback, buy new strike. Sometimes you need to buy a new strike for the same symbol, but instead of adding to the same position, which is not good, you may add to the same position via different strike and a different month. So you sell the original position at loss or break even, and the other one is you are make because you just open a new trade, so you're making money in the new strike and new month, and that gain is compensating the loss in the original one. Or the original one, your objective become to break even. The break even trade is a winner trade. So if your objective is to break even, if you were losing and now it's moving, you don't want to add to the same strike because that strike could be out of the money and the time is not in your favor. So you want to buy maybe in the money in a different month, and the existing out of the money in the current month, your objective is to sell at break even. Or you can create a vertical spread. So when the target hits the red, when the stock hits the red target, maybe you can sell another strike out of the money and convert your trade into vertical spread. So you have locked your gains, and now you're just adding some more profit into it. So this is the end, and I will continue to hold these kind of a short sessions to teach you, and so that you can maximize your gains via Trade Genie notification. All right. So if you're slow in entering the price suggested, if you're slow in entering the price suggested, um, keep your order ready. Just put the limit order, and it will hit. So no need to chase. No need to chase. If you think you have to chase, so only you know at that time that you have to chase. So instead of buying 3 contracts, let's say just buy one, and the other 2 you buy at the lower price. So eventually your cost will be the same. Okay. All right. And if it's just moving far, then you just let go because there's always another trade. So thank you for coming, and I will be holding another session next week. And if you still have not understood, then please ask for our 71-page guidebook, which is getting edited and revised. We will be sending a new one, but for now, you can send email to support at Trade Genie, and they will send you the guidebook. And we are always here to help you. So objective is to help you make money and educate you. So education is very important, and it doesn't come fast. It's just slow. So I hope you learned something and some alarm bells going on in your head, some notes you have taken, some action. So think about it. You can listen to the recording tonight when it's loaded in YouTube, and then maybe take some note and say, okay, he said this. How can I do this? Or he mentioned this and I'm not doing this. Maybe I need to look at this. There's some aha moments going on, and some implementation, some execution plan, some improvement, calling your friend and discussing that, okay, what do you think about this? So something needs to go after you leave in like in the next 15 seconds. After 15 seconds you leave, you need to do something about it. I'm going to do something about it because when I was talking, new things come in my mind that I was talking this and I need to implement this. I have my own idea. When I'm teaching, I'm saying, okay, I said that, but I don't have that. And how about I do that? So I'm going to take notes on my phone or on my notepad and start implementing. And always don't worry about starting big with the bang, because when you're trying to start big with the bang, you're always late. So start simple but fast. So start simple and fast, and then you can grow into it, and it will become a castle. So don't think of starting something big, because when you start something big, it will be late and it's already cost the damage. So start something fast right away. It needs to be very simple. Just create maybe a blank Word document and put it in your folder as a reminder that you need to put something. Take notes, something you need to write, and take some action before you go to sleep. All right, so I'll see you next Monday. Thank you.